Hello, everybody, and welcome to the next installment of the REACH financial series for Butte County Library. So today's topic, we're going to cover taxes for individuals. Last time we talked about business taxes and how if you have business income, you might want to file in one way or another, depending on the kind of business that you're operating. And today we're going to focus more on personal taxes. And the reason we're doing this in March is because a lot of people typically would start filing their taxes. They kind of put it off a little bit and they start looking around April 15th is when they're the deadline to file. Actually, this year, because of the way the calendar lays out, it's actually April 18th, but typically it is April 15th. So we're going to talk a bit about taxes, individual taxes, kind of an intro, some things that you might want to know about, some ways that you might be able to lower the amount of taxes that you pay, and some things that you might want to know about before it becomes the due date, right? So let's get started. So first off, this is part of a series for Butte County Library's REACH program. And so here's a link here so you can see the other services and the other information that's available through the REACH program. This is just one part of an overall series. There's also a lot of topics about entrepreneurship and small businesses and getting employment in Butte County and all kinds of topics surrounding economic education, financial literacy, all those kinds of things. And so this is just one piece of an overall group of educational services. So I also want to let everybody know who's here that they can feel free to ask questions at any point. You can send a question in the chat, or you can unmute yourself. Anyone here who's in person can raise their hand and ask a question too. So first off, let's talk about taxes. There's a lot of them. And so these are just a general list of a bunch of different kinds of taxes that exist in our society. And in California, we have a lot of unique taxes to California specifically. So each state will enact their own state taxes. And then the federal government has taxes as well. And depending on the city that you're in, you may have specific city taxes as well. And it really, I'm going to focus mostly on people who live in Butte County. And for me, I live in Chico. And so I'll talk about, some of the things that we have going on here in Chico. But if you're watching this video and you live somewhere else in California, or you live maybe in a different city or town within Butte County, there might be just some slight modifications, but generally city-related taxes are not so huge that they make up a large portion of the total tax that you're going to be considering. One that is city-specific is transient occupancy tax, and that's actually a tax that's paid for hotels and motels and those kinds of residences where there's just a tax that's paid for people who stay overnight in those kinds of places, right? So that would be an example of a city tax. There's also sales taxes for businesses, like here in Chico, the Downtown Business Association, all of those businesses pay sales taxes, and those end up going to the county. They end up kind of doing a little bit of a loop around the state, but eventually they get to the county and to the individual city too. So we'll talk about mostly today is income tax. Income tax is the big thing that most individuals need to think about. They usually think about it in April. You actually can start filing for your income tax in January. The IRS has like an official open day where you can just start filing as of that day. The reason you might want to wait a little bit after January, even if you want to be early, being in February is great. You want to wait until at least the end of January because your employer and people who are businesses who are required to send you statements about how much money they paid you from the previous year, they have until the end of January to send that. And so if you go to try to file your taxes January 1st, you're not really going to have all the information available yet. You might, if you're really, really organized, you might already know, I know how much I got paid from this job, and I know how much I made from this rental income, or whatever you have going on. You may already know that information, but when you get that statement from your employer, it'll have how much was taken out for FICA, which we'll talk about in a minute, how much was taken out for withholding, how much was taken out for all the different things that come out of your paycheck, right? And so it's generally just a good idea to wait until the end of January, until you have all the information that you need, and you can just file, early in February. And I did that. I have all of my paperwork set up, ready to go on January 30th. Ready, like I'm set, and then I make sure there's nothing else I'm missing, and then I file early February, and I actually end up, because I file early, the IRS isn't as bogged down as they will be come April. And so I generally get, if I get a refund, I don't, but I generally get everything processed and they accept it almost immediately and it's good to go. And I don't have to stress about waiting until April and trying to get in before a deadline or anything like that. So when you're filing income taxes, and for residents of the state of California, you're going to have a 1040 form for your federal IRS taxes, and you're going to have a state 540 form for the state of California. Every state's going to have their own forms, and it's different. If you live in another state, you'll have different forms, and I really can't speak to every other state. I know about California, and I know about the IRS federal taxes. So I'm going to approach this from the perspective of Butte County residents, because that's who the majority of this information is for. And so for California, you're going to file a 540, and you'll file a 1040 for federal. If you happen to live maybe part-time in one state and part-time in another state, or you maybe have moved within the year, then you may have to file returns for 2 states. So for example, my wife and I moved from California at one point in our past to New York, and then later moved from New York to Arizona, and then from Arizona back to California. And so during those times that we moved, we ended up having to file the IRS 1040, the 540 for California for the periods that we were in California, and then the individual state forms for New York and Arizona when we moved then too. And so if you're in that place, then you might need to just consider other state filings as well. So what income do you need to include in your taxes? So not all income is taxed, and I'll talk about an example of a really common example of non-taxed income in just a second. But generally, any income, they call it constructive income, meaning if you are receiving it or somebody who's acting on your behalf is receiving it for you, then it's considered your income. So for example, somebody who maybe is elderly and has someone else, like a relative, handling their finances for them, well, that relative might go pick up, a paycheck or get some income on behalf of the elderly person. That elderly person has received that income because someone else got it on their behalf. And so it's kind of a little bit of a flow through there. So that's just something to be aware of. It's not physically, do you have cash in your hand? It's about whether that income is available to you. And so if it goes into your bank account, if it's a check that you've received, but maybe you haven't cashed yet, that still is available to you. So it's still considered income. The company who pays you will report that as them having paid you, regardless of whether you have actually cashed that check. So just be aware that you should probably go cash that check within the time frame. If the check expires and it doesn't get in, you don't deposit it and you never get paid, then maybe you can go back and rework that with the company that paid you. But just be aware that once it's constructively received, meaning that you have the ability, you have the access to those funds, it's taxable. So employee wages, which most of us know, if you work a job where you are paid, we call it a W-2 employee, every January, you'll get a W-2 from your employer. And that's the kind that we're most familiar with, where you work maybe an hourly job, you get paid maybe a salary, or you just, something like that, where you are employed for a certain amount of time, or you are paid a set amount for something, either per hour, per day, per year, something like that. There's also income called fringe benefits. And these are benefits that you get in relation to the work that you do that might not actually be a paycheck. So for example, if you get a company car, that can be considered a fringe benefit. And fringe benefits also apply to other people who receive benefits based on your employment, which is kind of a funky thing to think about. But for example, my wife and I both work for Chico State, right? The CSU Chico. And as one of the benefits available to us as employees, we can receive tuition waivers so that I could take classes at Chico State for either for free or for a heavily discounted price, depending on the class. But so I have that available to me. And before I started working for Chico State, my wife already was working there. So when she was working at Chico State, I used her benefit for free class so that I could take classes for free at Chico. And so I used her benefit. That was a fringe benefit to her while I was working at a different group. And so that's a fringe benefit that was taxable. And so that's an income. Even though I wasn't paid any money, I was given free classes. And so you think, well, there's no actual money changing hands there. You still have to account for that. And so Chico State accounts for that they have provided classes to someone, and that they were not paid, so they paid for it, right? And they consider that income to my wife, but we're married, so it's a joint income for our household. Other types of income would be business income. If you operate a business, at various points in my past, I've worked as a W-2 employee while also operating a business on the side. And so both of those combined would then be my full income. So business income can be treated a little differently, and it really depends on the kind of business that you operate. If you go back to the last tax webinar that we did, where we talked about business taxes, you'll see that there's a bunch of different kinds of businesses that you could be operating. If it's a sole proprietorship, then it's just your income from your company flows through to you, and it's just considered your income as if you were working. But if you have maybe a C corporation, then your business would have its own income and maybe pay you a wage, right? And so the income for the business as a whole is not all of yours. The business itself may pay taxes, and you may receive a wage from that business, depending on how you structure it. So business income can be a little bit tricky, and it really, I can't answer every question for business income in the span of this presentation, but generally it would require you to consider the kind of business that you operate and how those cash flows get to you. So the other thing that's kind of new recently, and I want to make sure I touch on it, is virtual currency, cryptocurrency, NFTs, those kinds of things. And as of now, the IRS is treating those as property. So if you had acquired some kind of property and then sold it for a profit, that could be cars, for example. I like cars. So occasionally I like to buy old cars, like 1930s old cars, and fix them up, do a little hot rod type stuff, and then sell it. And sometimes I sell it for a profit, right? And so if I did that, that could be considered a capital gain. I bought a car for a small dollar amount, sold it for a larger dollar amount. That's profit to me, and I would have to pay tax on that profit. Well, virtual currency, like let's say Bitcoin, for example, Bitcoin works the same way. If you acquire Bitcoin for some dollar amount, you bought it at some price and then later sold it for another price, and if it's a higher one, you made profit, that could be considered capital gains. And we're going to talk pretty in depth about capital gains in the next few slides. But those are all different kinds of income that can be taxed, and they're all taxed a little bit differently. So we'll go through some of these and how they work. But generally, the way that your taxes are going to work is you're going to have income come in, and based on the amount of income in a couple different buckets, but generally regular, ordinary income, you'll pay a tax based on how much income you have. And so we'll talk about that in detail in just a second. But let's look at the first example here is if you're a W-2 employee and you get a paycheck, right? And so most of us, working adults kind of already understand how this works, but I just want to make sure I highlight it for those of you who maybe are just getting started in the workforce or maybe have never actually looked at it. There's a lot of misconceptions about how taxation works in our country, and people think they know, oh yeah, it's like this. And I've heard from, I teach financial planning at Chico State, and I've heard from students, I've heard from other faculty, I've heard from other adults who you might normally expect to really know their stuff about this, that things that they think are true that really aren't. So I'm going to go through some basics here just so that everybody is kind of on the same page. So FICA taxes are the funds that are taken out for Social Security and Medicare. Right. And so Medicare comes out at 1.45% of whatever it is that you're getting paid. Oops, let's try that again, 1.45%. And then Social Security comes out at 6.2%. And so whatever you get paid, that's the 1.45 and 6.2 up until when you get to a certain point, there's going to be, you have to be making a lot of income for that to change. But generally for most people, I'm going to say for 99% of people, that's going to be the case where you're paying whatever amount you make, 1.45% of that gets taken out for Medicare and 6.2% gets taken out for Social Security. And then your employer, when they pay you, they also match that amount. So if you can see for this paycheck, this person received $800 in gross earnings. There we go. So $800 over here in gross earnings. And that was just the amount that they were paid hourly times the number of hours they worked. And so from there, they then took out the Medicare and Social Security for $1,160 and $49.60 right here. You can see those two. And so if that was the amount that was paid or that was taken out for the employee's portion, the employer also paid an additional $1,160 and $49.60 into Medicare and Social Security as well. And so that's the payroll tax stuff that comes out. Now, the bottom part here, federal income tax and state income tax are the two pieces that are withheld. For this person, it looks like, this is just a sample that I found on the internet. So this is for somebody who lives in New York, but it doesn't really matter. For whatever state it is, they'll take out some amount for federal, they'll take out some amount for state, and they withhold that. They set that aside on your behalf until you go to file your taxes, your tax return, generally in April, and then they'll say, here's the amount that was set aside for you. And if you owe, let's say you do all the math for your taxes and you owe $1,000 for the year, and you look at that set aside, and that set aside is equal to $900. Well, you owe 1,000 and that set aside is 900. That means you actually only have to pay 100, right? And then that will go to the IRS. Generally, when people receive a refund, it's because they did the math. They found, okay, I owe $1,000 in taxes for the year. I look at my set aside and it's 1,500. And you say, oh, well, then they've withheld more than what I actually owe. So I will get a refund of 500 at that point. And it depends on, we'll talk about deductions and credits here in just a second, but depending on how many deductions and credits you have, and you can lower the amount that you owe, and that set aside amount that's been withheld from each paycheck, that part won't change until you figure out how much you owe, and then you can get a refund of the overpaid amount, or you might have to pay an extra if the amount that was withheld from your paycheck each month or every 2 weeks. If that wasn't enough, you might have to pay more. So for me, when they take out some amount of tax from my paycheck every month, I get paid monthly, and it's never enough. And so when I go to file my taxes, I owe more, generally more to the state, but not generally more to the IRS. And that's because of where my income lies and how my taxes lay out, but it'll be different for everybody. So a couple things to know about our tax system before we get into the actual details here is we are on what's called a progressive tax system. And that's not like a political statement or anything. It just means that as you make more money, you're going to have to pay a higher percentage in taxes. But it's not, one of those misconceptions that comes up a lot is that people think, well, if I make this many dollars, then I'm paying 24% because I'm in the 24% tax bracket. And I'll show you how the scale kind of works, but it's not, you don't just pay a flat percentage of all of your income based on what bracket you're in. You pay a little bit in each bracket until you get to the point of wherever your income is. And it's a little bit confusing, but I think if I write it out, I'll be able to show you how it works. A couple other things to know: tax deductions and tax credits are two ways that you can lower the payment that you make to the government every year when you pay your taxes. And both of them are great, but they have different influences on the total amount that you pay. So a tax deduction, the way that I teach my students about tax deductions is I tell them to think of it like you're telling the IRS you made a little less money, right? If you made, for easy math here, I'm going to say, if you made $100,000 for the year and you had $1,000 in deductions, then your $100,000 will be lowered to $99,000. And now you tell the IRS, well, I only made $99,000, not $100,000. And so I'm going to pay taxes on $99,000. Now, the way it actually works is you'll tell the IRS all of that information. So they'll know that you paid or that you received $100,000, but you will still only have to pay taxes on that $99,000 if you had $1,000 in deductions. Also, in the real world, you're going to have more than $1,000 in deductions. Everybody is eligible for more than $1,000 in deductions, but we'll get to how deductions work there and the actual amounts of them in just a sec. Tax credits, on the other hand, will lower the amount of your tax bill. So if you made $100,000 and let's say you have no deductions, then you're going to pay, I don't know exactly what it'll be, but something around $20,000 maybe, or you'll owe about that in your annual tax payment. But if you have, so let's say you owe $20,000 after doing all the math for deductions or something, and now you say, okay, well, I have some credits too, and I have a $1,000 credit. Well, your $20,000 payment will go from $20,000 to $19,000. Tax credits will lower your bill dollar for dollar, whereas deductions will lower the income that you're paying tax on. Credits will lower the actual tax bill. And that's really great because that actually has a much larger impact on your overall tax payment, the credits do, than the deductions will. Because you're paying a percentage of your income, but the tax credit, so if you have a $1,000 deduction versus a $1,000 credit, a $1,000 credit will lower your tax bill by a full $1,000, whereas a $1,000 deduction will only lower it by whatever percentage of your top tax bracket that you're in. So it may lower it by 24% of $1,000, $240, something like that. And so, okay, so credits will reduce your taxes a little bit more than deductions will. So if you have generally you can take both deductions and credits, so it's not like you have to pick one or the other, but if you have a way to increase your credits, that's going to be a better benefit to you than increasing your deductions would be. Now, when deciding about how much to deduct in taxes, there's a few different courses of action you can take. So itemized deductions, you might have heard that term before. When you itemize your deductions, what that means is you're making a list of all of the different costs that you had over the year. And saying, okay, here's all my costs that the IRS allows me to remove from my income. Remember, a deduction is kind of like telling the IRS you made less money, right? And so if you can make a list of all the different costs that are allowable for deductions and say that maybe those are $30,000 worth of costs, maybe there's a lot of expenses there, then you can say, I'm going to itemize my deductions. I'm going to lower my income that I pay taxes on by about $30,000 and then pay less taxes that way. Now, if you don't want to itemize your deductions, either because it's a lot of work, if you have to keep track of everything, right? You keep all the receipts and you keep track of everything that you paid money for and which ones are deductible and which ones aren't. Not every expense is deductible. You can't expense, just going to dinner with your family, every night of the week. Right? That's not a deductible expense, but some expenses are deductible, right? So you got to keep track of which ones. That can be a little bit of a hassle, and many Americans decide to take what's called the standard deduction. And again, the way that I teach my students about standard deduction, I say, you can think of it like an agreement between you and the IRS, where you say, listen, it's a lot of work for me to try to itemize all my stuff, and it's a lot of work for you to try to check and see if I didn't make any mistakes. You have a conversation with the IRS, hypothetically. And so the IRS has this, standard deduction in place where they say, listen, yeah, absolutely. We don't want to do the work. You don't want to do the work. How about we just call it this amount? And I'll get to what the standard deduction is in a second, but depending on, let's say you're a single person, you say about $12,000, we'll agree it's $12,000. You don't have to prove anything. We don't have to check anything. We'll just agree that that's the standard deduction. And that's one way you can go, so that you don't have to really do as much work on your end, right? And the IRS doesn't have to do as much work checking on all the things you reported. So that's called a standard deduction. Everyone is eligible for a standard deduction, and you can just take that, check that off and be done and move on. Unless you have lots and lots of costs where it would be financially beneficial for you to actually list out every cost and get a much larger deduction if you did the work, right? So we have a progressive tax system, like I mentioned, and so this is the 2021 tax bracket list. And so you can file taxes in a few different ways. If you're a single person, then you can file as a single person. If you're married, you can file jointly, or you can file head of household. There's also one for like a widow or widower. That's an option as well. It's just not as common. So for single filers, let me find my pen. There we go. So if I'm gonna do the math as if you were a single person, but the same general idea holds up for the other ones. They're just different numbers. And so for a single person, if you made less than $9,950, you're going to pay 10%. Oops, you're going to pay 10%. Of the income that you made up to that amount, but that's the taxable amount. So the taxable amount you made was $9,950. That would be after your deductions, right? So let's say you made $15,000 in the year, but you took, let's say $6,000 in deductions, which is not reasonable, but let's pretend that you did that. Yeah, $15,000 in income and $6,000 in deductions would leave you with $9,000. Oops. I'm just gonna write 9K. Uh-oh, let's try that again. Oh, my pen decided to mess up on me. There we go. Okay, we're gonna try this one more time. Okay, so you would have $9,000 in income for the year, and so you would pay 10% of that $9,000 in income, and 10% of 9,000 would be 900. So you'd pay $900 in taxes for the year, having made $15,000 for the year, but taken 6,000 in deductions, right? And these are made up numbers and not very realistic, to be honest. I mean, most people are going to hopefully be making more than $15,000 in a year, and you're certainly going to have more than $6,000 in deductions, but let's just pretend that those are real numbers. And so paying $900 on 15,000, I'm not quick with mental math, but I'm going to say that's less than, I know it's less than $1,500, so it's less than 10% actual effective tax. So the amount of tax that you actually paid is something more like 8% maybe. And that's just me trying to mental math off the top of my head, but something around that amount. And so you end up actually paying less than whatever the actual tax bracket shows. So just because your tax bracket says 10, 12, 24, 22, 32, you're generally not actually paying 24% of your total income in taxes. That still doesn't mean that you want to pay, you don't want to pay as much. If you can help it, you want to pay as little as possible, right? But at least it's not as rough as what you might see just looking at those percent numbers on the side. So if you were, so the way that the brackets work, if you were to make more money, then you would pay, let's say you made, I'm going to erase this and say, what if you made, I'm going to say $35,000, right? After deductions and everything, you're at $35,000. So you made some higher amount of money, you deducted some other amount. My pen seems to not be wanting to participate here today. Let's try that. One more time. Okay, so you made some higher amount of money, but then after deductions, you were left with, I'm gonna put, okay, $35,000 in taxable income. For the first $9,950, you're gonna be paying 10% of that. And then that's gonna leave you with about, let's say, that's about 10. So it'll leave you with about $15,000 that you're gonna pay 12% on. So 15,000, So $15,000 at, so that'd be times 12%. Let's try that again. There we go. $15,000 times 12%. And I'm rounding a little bit, right? I'm about $50 off, but you can do the math and say 9,950 times 10%, and then your 35,000 minus the 9,950 leaves you with about 15,000 times 12%, and that'll get you the actual amount of tax that you're going to pay. And so you'll pay about $900 in the first bracket, and you'll pay whatever 12 times, you know, about $1,200 or so. Oh, no, it would be more than that. $1,800 maybe. I'm trying to mental math here, but something about maybe 18 and 9 put you about $2,500 in taxes on 35K. So you're probably still paying closer to 10%, definitely below 12% at that point. And you can do this for each of these tax brackets. Now, I know a lot of people are going to use tax software, and so I'll get to some other tax software solutions in a little bit, but they'll do the math for you, so you don't necessarily have to do it all yourself. Okay, the other kind of taxable income that exists is called capital gains tax, and it's taxed at a different rate. And so this tax table that I just showed up here is one table, and that's for ordinary income, just the regular income you get from wages, you get from flow through from a sole proprietorship, or other kinds of income that are just regular, ordinary income, they call it. So basically income that you've worked for. There's also capital gains taxes, which the IRS doesn't necessarily consider it to be income that you've worked for. They say, well, yeah, you were profitable on an investment, and so you're going to pay taxes on it, but it's not the same ordinary income as working would be. So capital gains tax is when you own an investment, it goes up in value, and then you sell it for a profit. And they differentiate between short and long-term capital gains. And so a short-term capital gain is one where your investment, you only owned it for less than 1 year. If you owned it for less than a year, then they're going to consider ordinary income. They're going to say, well, it was just kind of a speculative thing, and maybe you bought a stock, it went up immediately, and you sold it within a week. That happens all the time. People do that pretty regularly, but the taxes on that will be treated as if you made them just like you did if you were working for a job. And so you're going to pay taxes just like that same tax bracket, right? All of the different income will be included there, and you'll pay taxes on it. It might move you up to a different tax bracket, but we know that that's not really going to harm you as much as you think, as what you might think based on just those percent numbers, right? If you have an investment that you've owned for longer than a year, and I mean, it can be 1 year and a day, it just needs to be longer than a year, or it can be 10 years, or it can be 30 years, it doesn't matter, but as long as it's longer than 1 year, then that's called long-term capital gains. And generally, the idea with tax policy for any country, but in the United States, our tax policy is usually set in a way that we try to incentivize people to take certain actions. And the IRS for a very long time has had long-term capital gains be the lower is taxed at a lower rate than other types of income. And the reason they do that is to incentivize people who have extra money to invest for the long term, right? The IRS is trying to encourage people to take actions that they think, and in generally probably that's true, is that they want to encourage you to take actions that are probably for your benefit and probably for everyone's benefit. If we have, as a society, more people investing for the long term, we're probably going to be a wealthier society, and probably people are going to be less stressed, probably less medical issues, probably less emergencies, all kinds of other things. And there's probably some statistical studies that show there's probably less crime as well. So all of those things are benefits to investing for the long term, and the IRS tries to incentivize people to do that by saying, if you do invest for the long term, we'll tax you at a lower rate. And so if you're in, for 2021, they change tax brackets every once in a while, but the capital gains, long-term capital gains tax rate hasn't changed just recently, I don't think. And so if you're in a long-term capital gain, so you own an investment for more than a year, you've sold it for a profit, you could be taxed at either 0, 15, or 20%, depending on your income. And the 20% one is really high. So is really high amount of income. You'd have to make lots and lots of money to have to be paying 20% of the capital gains in taxes. So for a lot of people, you're going to be at that 0 or 15 level. And so this is the tax bracket list for long-term capital gains. And so if you made a profit of $40,000, $40,400 as a single person, or less. So if you maybe bought a stock and you made some profit on it, maybe you didn't make more than $40,400, then you wouldn't actually have to pay taxes on that at all. It's 0% tax rate for profits under $40,000. If you're a married couple and together you made less than $80,000, you actually have to pay, there's no tax on that, on long-term capital gains. You do have to pay 15% once you pass that first bracket, but it goes all the way up to, for a single person, $445,000. So if you're making $445,000 as a single person, you're doing quite well. Even in California, that's doing quite well as a single person. You're only going to pay 15% tax on that. Now, this is for long-term capital gains. This is not ordinary income, but for long-term capital gains, 15% tax rate is, I think a lot more reasonable than the $400,000 income from wages would put you in a 35% tax bracket if it was ordinary income, right? So, and you can see how this table might work depending on the way that you're filing. It is possible for married couples to file separately, and there may be some scenarios in which that is a beneficial arrangement, but generally, if you're a married couple, filing jointly gives you increased limits for a lot of different things. And it really, and actually gives you increased limits even for, if you compare single to married filing separately, single actually has higher limits for capital gains tax than married filing separately would. So just some considerations. If you are questioning whether, if you're married and you're questioning whether you should file joint or separately, that's probably a question for a CPA, because there are scenarios in which it is better to file separately, but they're few and far between. Okay, so let's take a look at the actual forms that you would file. So I said earlier, you'd file with the IRS with a form 1040. I'm gonna make sure I switch my screen share here. I gotta open this in a browser. And when that opens, I'm going to switch to screen share here. And so this is the 1040 form for 2021. And one of the things that a lot of people kind of mix up is that when you file your taxes, let's say you're filing in April of 2022, you're actually looking at all of your income in April of 2022, you'll be looking at the income that you made during the year of 2021. So when you file your 2021 form, you can see on this form that it says 2021. When you file that form, you'll be filing it in April of 2022, or sometime between the end of January and April 18th of 2022. You'll be filing this form that has the 2021 number on it, because what you'll be recording is all the things that happened during the year 2021, right? And so if things have changed between December 31st of 2021 and the time that you file your taxes, well, those things don't need to be reflected on this, generally. Sometimes they do, but generally they don't need to be reflected on this form, because this form is just showing what happened during 2021. They do have some demographic type questions, right? Your name, your social. This is so that they keep track of you. I guess that's technically not a demographic question. That's just, they want to be able to identify you. So personally identifiable information goes at the top here. And that's to make sure that they attach your filing to your profile on the IRS database on the back end. A few questions about those kinds of things, whether or not you are dependent or not. So maybe I work with a lot of college students and they're maybe 18 years old. And so it's their first time being an independent person and filing independently, right? Because they're no longer being supported. Sometimes they're being supported by their parents, but sometimes they're not. And so, whether or not that applies to you, you can check that box. And then if you have dependents, and so you might have noticed, if you do have children, you might have noticed that you were receiving a child care tax credit rebate during the year of 2021. And that would be based on the number of dependents you have and their ages. And so you should definitely list those in there. There's not really any downside to having more dependents. If you have someone who's dependent on you, it doesn't necessarily have to be your child. There are other people who can be dependents to you. And so you can see one of them is what's the relationship. And if they are maybe an elderly person that you care for, they can't care for themselves and you care for them full time or something like that, that could be a dependent of yours. They wouldn't necessarily be a child tax credit because they're not your child, but they still would help, or them being a dependent of yours would help in your tax burden. It would lower the amount of taxes you have. There's also quite a few other types of, so the first top part here is types of income. And then you can see down here, we talked about the standard deduction, right? Or itemized deductions. And so you can itemize your deductions, list out all the different costs, and I'll show some examples of itemized deductions in a minute. Or you can take the standard deduction, and it says right here, it's the standard deduction for single or married filing separately is $12,550. So at minimum, you can reduce your taxable income by $12,550 if you're a single person, or if you're married filing jointly, 25,100. So if you're a married couple and you received, I'm going to use easy math again. If you received $100,000 in income as a married couple, you could take the standard deduction of 25,100, which will lower the amount of income that you are paying taxes on to $74,900. So rather than pay tax on 100, you're paying tax on 74,900, and that's going to be significant tax savings just by taking that standard deduction. Now, if you had itemized deductions where you could list out all your costs and all those costs totaled more than 25,100, then by all means you should itemize. Unless they total $25,101 and you say the benefit of saving $1 more versus doing all the work, I'm just going to say forget about the $1. But if you maybe totaled all your deductions and they totaled maybe 35,000 instead of 25,000, I mean, that's a $10,000 reduction in taxable income. That's probably a pretty good benefit. That might be worth your time to actually put together your list. And you use what's called a Schedule A to just list out your itemized deductions. All of these schedules, you might see a bunch of references to schedules. So Schedule 1, Schedule D, you can kind of see those on here. Those are all available from the IRS for the most part. If they have an actual name like Schedule A, Schedule 1, and Schedule D, and those kinds of things, you can go to the IRS website, irs.gov, and search for that schedule for 2021 and print that out. And you can get it, you can file it yourself. Sometimes it'll say attached schedule and it won't actually say a name. And so the way that I've done that when I was doing taxes for businesses and for myself is if it says attach a schedule, but doesn't have an actual, like a specific filing that the IRS is looking for, what I do is I create my own schedule using Microsoft Excel. And it's really just line items and labels saying, here's the dollar amount, here's where the justification for why that counts, you know, a little bit of notes maybe, and then totals. Sometimes if it's for a business, I might have like depreciation or something like that. So I might total up, you know, here's the type of depreciation that we're doing. Here's how much has accumulated so far. Here's the amount that we're deducting for this current year, right? It's a little bit of work, but it's going to save me a lot of money if I put some effort into it, right? So sometimes you can create your own schedule. Generally for personal income taxes like this, not business income tax. For personal income tax, most of the time there's already schedules created by the IRS and you just fill in the blanks on their forms. So you take you have some of your income. So IRA distributions is an example of an income that you might have to pay taxes on. A traditional IRA, which is one kind of retirement account that you would pay taxes on when you retire. There's also another one called a Roth IRA, which you do not pay taxes on when you take money out of it. And we can talk about different retirement accounts in a different webinar, but those are generally the kinds of IRA distributions. You'd have either a traditional or a Roth IRA. Generally, there are other kinds of IRAs, but those are the most common, traditional and Roth. Also, you might have a pension. That would be something like, for me, I have a CalPERS pension, right? I'm not going to receive it until I retire, and I have to be a certain age, and I have to have worked a certain number of years. And so once I get that, I can have a pension where they will pay me regularly for the rest of my life. And so the income from that pension is considered income as well. And so you can fill out this form just, you know, saying here's how much, you'll generally get a schedule. So you'll get a W-2 from your work and you can fill in, you can copy, just write those numbers exactly. And then any boxes that were filled on your W-2, you can copy and paste some of those numbers there. Sometimes you might have to add up a couple. So they've actually significantly simplified the 1040 form from how it used to be. And they used to have, when I was first getting into like doing taxes for others, they had different kinds of 1040s. There's a 1040A and a 1040EZ. And depending on the kinds of life situations you had, you'd have different kinds of forms. But now, most of the time, everyone's just going to file a 1040. So they simplified it quite a bit. So it's just an example of some other things, right? You might have other, you might attach your W-2. You should attach your W-2. When they send it in a quad, like a 4 sheet. And so one of those corners will go to the IRS. One of them will go to the state. One of them you'll be able to keep for yourself. And one of them you might, depending on the city, I don't think in Butte County you'll have to do it, but I don't know every city's tax policy within Butte County, but at least in Chico, you don't have to take that 4th piece and send it to the city of Chico. That's a little too much, but I can imagine there may be cities somewhere else in the country where you do have to file. I would imagine they'd be like major cities, maybe something like New York City or even LA or San Francisco, but I'm not 100% certain on that. Okay, and then maybe some credits. And what I'm going to do is I'm going to go back to the PowerPoint because I have a list of deductions and credits that might be useful for people to know about. I'm going to make sure I'm switching my screen share here so that we don't forget to show what I'm showing. So on the 1040 form, we kind of looked at that. The 540 form is very similar. It's actually, I'll actually just show it really quick because it's mostly the same. Make sure I screen share appropriately again. So on the California 540 form, you can see it's the same thing, 2021, because we're filing everything that happened in the year of 2021. 540 is just California's number. That's what they use. Other states have different numbers or different letters sometimes. They ask about stuff about you. They ask about if you're single. The first page is very similar to the top half of the 1040 form. And then your dependents, same kinds of questions, right? All the same stuff. State wages, so this will be from your W-2. It even says on here, box 16 of your W-2, which is that number, right? And so then you can, any adjusted gross, so you could figure out what your AGI is from your 1040. Generally, you want to go 1040 first, then do state afterwards, because you're going to have to take numbers from the IRS and put them on your state form. And then itemized deductions or standard deduction, right? So the state forms are relatively similar, mostly similar to what the federal form is. There's some unique things that are specific to California that may not be, may not exist in other states. And so just something to be aware of, right? There's a renter's credit. So if you're renting an apartment or a house or something, there's some instructions for that. I generally would encourage you to read the instructions if you're doing this yourself. And then you'd be able to calculate your tax and make a payment, right? And if I go all the way to the bottom down here, there's quite a few things, but what you can do is if you want to make a payment, you can put in your account information and they can withdraw from your account, or you can have it direct deposited to your account. You can send a check, you can attach a check and send that in as well if you want to. The way that I do it is I use an online service so that I do all my things e-filed so that I can make sure everything's good to go. I want to make sure my if I do get a refund, that it's done quickly, but if I owe, then I can schedule the date in which I want the payment to come out. And so what I do, I owe California money every year. Every year when I do taxes, I owe California quite a bit. And so I schedule it to, I file my taxes at the beginning of February, but I schedule the payment to not actually come out of my account until April 18th, which is the deadline to pay. I wait all the way until the finish line, right at the end when I pay. But that may be a little bit risky for some people if you're not, not willing to do that. Also, you have to remember that that payment's going to come out in the future. And so you need to have the savings set aside so that you don't spend it. And you want to make sure that you don't accidentally, spend the money that's supposed to go to the state, and all of a sudden that payment comes out and it's a bounced check, right? And you don't want that, because if you don't pay on time, the state's gonna charge you a bunch of fees and penalties. Okay, so let's go back to the PowerPoint. We got a few other things to cover here, and I want to make sure that I stick to my time frame. So examples of deductions that you could take. So standard deduction, we already talked about that. That's the one where you say, listen, I don't want to do the work of calculating all the deductions I have. You don't, IRS, you don't want to do the work of checking my math. How about we just say for a single person, $12,550, and we'll call it good. And they might say yes. Hopefully they say yes. And if it's a married couple, you say, how about we just call it 25,100 and we call it good? And they'll say yes for the standard deduction, and you just move on. They won't, there's no question about the standard deduction. They'll actually, as long as you check that box, it'll go through, and there's no yes or no really about it. As a joke. Contributions to charity. So you can reduce the income that you pay taxes on by donating to a charity. So for example, I donate to Chico State, but I also donate to some other organizations, nonprofit organizations in town. And so if you make donations to charities, or it can be, I think churches count, or other types of 501c3 nonprofit groups. And you probably know, I won't list any for fear of leaving any great ones out, but what causes are important to you. And so if you donate to a charity that's a 501c3, they can send you a statement saying, here's a statement showing that you've donated to our 501c3. Here's our nonprofit ID number, so that you can report, yes, I did make a donation to them. Here's the proof from them that I did it. You also can deduct some amount of money that was donated to nonprofits without any records of it. And I think it's about $600 for the year. where you don't actually have to have a statement from the charity showing that you made a donation. And that's allowing people to account for things like just a cash gift. So you can imagine there's a lot of different places where someone says, hey, would you like to donate to this group? And you say, oh yeah, sure. And it's just like extra cash, maybe the change from the store that you're at, right? And so it's not really like, you didn't sit down and write a $10,000 check to your favorite organization. You just maybe gave them a few dollars while you were at the store. And so you can, if you keep track of the amounts that you're donating to charities through maybe a little bit of an informal donation like that, you can deduct up to $600. And so I regularly make gifts, small gifts, but I know I keep track of the gifts that I make to other groups because it's just a regular occurrence. So I know every month this amount gets sent to this group, and I don't bother keeping track of the receipts from them. I just know that 12 times, because I paid every month, $150 or so for the year, something like that, gets sent to this group, and I'd make a deduction about that much. And so that's one choice as well. Contributions to retirement accounts is another deduction. And so if you put money into a traditional IRA or a 401k or a few other different kinds of retirement accounts, the most common will be a 401k or a 403b or a traditional IRA. Those are the ones that most employees and most people in America are aware of, but there are other types of retirement accounts. And depending on the kind of account, you may be able to deduct quite a bit. If you, for a 401k, for example, you could contribute I don't remember the exact amount, but it's something more than $15,000, $18,000, more than that even, that you could put into a 401k every year, and that could be a deduction as well. For an IRA, it's a $6,000 a year limit. So you can put it $6,000 a year into a traditional IRA and deduct that from your income as well. For a Roth IRA, you don't get a tax deduction. And so remember, for a traditional, you can put money into a traditional account, take a tax deduction, and then when you withdraw money from the traditional, you pay taxes on it then. Those are called deferred taxes because you're not paying the tax now, you have to pay it in the future when you withdraw the money. With a Roth IRA, you can put money into a Roth, not pay, you don't get a tax break for putting money into a Roth. You don't get any real benefit in the short term for a Roth. But when you take the money out, you also don't have to pay taxes on it. So you paid the taxes on your income now because you didn't get a tax break now. But then when you take the money out, you don't have to pay taxes on it because you already paid the taxes up front in the past whenever you opened the account and put the money in. And so generally, depending on your life circumstances, generally one or the other will be better. And depending on whether you think you might be in a higher tax bracket in the future or a lower one, or how you're going to kind of schedule the payments over the course of your life, one may be better or worse than the other. Then there's student loan interest payments, and you don't actually need to itemize in order to deduct student loan interest. And so, well, that's a really great benefit in that if you, whether or not you choose to take the standard deduction, you can already deduct up to $2,500 in student loan interest payments. So if you get a statement from, you have student loans and you're making payments, as of right now, federal student loans are on hold, but you maybe have private student loans. And so if you are paying interest on your student loans, then you're going to be able to deduct up to $2,500 on those. HSA and FSA accounts, which are used for medical expenses. An HSA is a health savings account, and an FSA is a flexible savings account or flexible spending account. And either of those, if you contribute funds to them, you can use them. If they're used for qualified health expenses, you can also deduct those. Casualty and theft, which unfortunately a lot of us in Butte County know about. If you were to lose property, it was destroyed. Fires, for example, is a pretty common one, or other kinds of property that gets destroyed. You can have a deduction for those. It depends on how it was destroyed or how it was lost, if it counts as a deduction without itemizing or not. And so you need to check if it's a federally declared qualified disaster loss. So the federal government has to declare it as a loss or as a disaster. And then if you lost it as a result of a federally declared disaster, you can deduct it without itemizing. So check the rules first to make sure you can deduct that. And then another one that's I think is really great is if you're a K through 12 educator and you spend your own personal funds on your classroom. My mom, for example, is a first grade teacher. And if she has to spend out of her own pocket for her classroom, for classroom activities or things related to education, she can deduct some up to a certain amount. I think it's $250. So it's not a huge amount, but it is helpful that you can deduct educator expenses as well. And unfortunately, well, fortunately and unfortunately, it is only for K through 12. So I, as a faculty member of Chico State, that's a university, that doesn't count. Even though I work in education, I do not qualify for the educator expenses. Other credits that exist as well. So they create credits for all kinds of different groups. If you're just an employee that maybe is in the lower side of earnings, then an earned income tax credit is one credit available. There's the American Opportunity Tax Credit for students. If you're a student of a university, you can, or continuing education even, then you can get the American Opportunity Tax Credit. Lifetime learning tax credit also exists for students, but you can't have both. So you get either one or the other. They don't let you double up on education tax credits. There's childcare tax credit. So if you have your children, if you're paying for childcare, you can have a credit for that. There's a savers tax credit if you contribute to a retirement plan, but you can't use the retirement plan contributions while also being a student and receiving the American Opportunity Tax Credit. I know there's a lot of connections here that you have to kind of think about, but each of these links here is from the IRS website or from a related description of how to claim those tax credits. And then the child tax credit, which I think if you have children, you're probably aware of it now because you received those rebates throughout the year, maybe. If you have children who are under 5, then you, over the course of the year, can have $3,600 credited back in taxes. And if your children are ages 6 to 17, then $3,000 for the year. So those are all direct reductions in the amount of tax that you pay because they're tax credits, right? They're not deductions of income, they're deductions of taxes that you pay. Couple options for tax filing software. So if you don't want to go through those forms that I showed you and do it all by hand, TurboTax is one example of a tax software. It's very popular. They have recently gotten in a little bit of trouble because they advertise the free version, but make it a little difficult to use the free version. So in the matter of full disclosure, there are other competing softwares available. And so another one that's becoming more and more popular would be FreeTax USA. They do the same kind of thing as TurboTax. And I've compared them for myself, and I've filed with TurboTax and FreeTax and another one called TaxAct, all put in my information, and they all come out to the same result. And so I'm at least for my personal experience, I've seen that they work pretty well. Your mileage may vary, so just check and see if that is a good solution for you. Another group that exists in Butte County is called VITA, and they're a partnership between Butte County and the Chico State and the city of Chico to provide free tax help for the residents of Butte County. So if you make less than $58,000 a year, they will help file your taxes for free for you. You have to go to their website, and if you just you can go to you can search for Butte County VITA. It'll be the first link that comes up, but it stands for Volunteer Income Tax Assistance Program, and they can help you file your taxes for free as well. The IRS does have its own free tax prep for if you make under $73,000 a year. It's a little bit more clunky. It's a federal government program, so it's not as streamlined as maybe some of the other software. They try to make it easier to use. IRS can be a little bit of a burden to try to navigate. So I do want to make sure you're aware that that is an option, but it may or may not be helpful for you. Good kind of thing to remember here is keeping track of your records. So make sure that whatever you do file with the IRS, you keep track of. I always keep printed documents as well. I have a big box at my house of all my financial information, and so one of those filings is all of my tax stuff from previous years. You probably need to keep it for more than 7 years is a good record retention rule. Probably after 5 years, it gets less likely that you're going to have a risk of any kind of audit or anything. But if you keep your records for 7 years or even up to 10 years, you're probably going to be just fine. Any longer than 10 years, you don't really need to keep it. The IRS is not going to come back for 10 years worth of auditing later on or anything like that. You can get a transcript from the IRS that shows your past filings, but they're not as detailed. They're not the same level. It's not just a printout of what you filed. It's like an itemized list of all the different things that they entered under your name. So it may or may not be useful for you to get a transcript. I generally like to keep an actual copy, like a carbon copy of whatever I sent in. Keep track of your AGI as well. That's adjusted gross income. Whenever you file your taxes, your AGI is usually what the IRS might ask for when trying to identify you later. They'll say, hey, in order to access your information, we need you to prove who you are. What was your AGI? What was your adjusted gross income? And you need to know it to the cent in order to make sure that you can identify yourself when contacting the IRS. Another great thing to do is to regularly pull your credit report. There are scammers out there who try to file your tax forms and get a tax return before you do. And if they file under your name, they can get, with a fake address, they can get the tax return that you should be expecting in your name. And then when you go to file your taxes, it turns out somebody's already filed under your name, and you have to kind of unwind this huge mess that happens. And so if you regularly are checking your credit report from annualcreditreport.com, that's the official source for getting an annual credit report, you can keep track and make sure hopefully your identity hasn't been stolen and somebody maybe was filing on your behalf. Last thing here is audits. So the IRS does audit people, and I know that that can be really scary, but the thing that I want everybody to be aware of is the IRS will never call you first and say that you owe them money and you need to pay it right now or else the police will come get you. That's not how they operate. They will always send you a notice first by mail to whatever address that you have on file with them. They'll send you a letter saying, here's what we think is incorrect, and you have an opportunity to counter that or make an argument about why you think no, that is correct, or something along those lines. If you see a letter in the mail and it's titled CP 2000, that is the IRS filing that says, hey, we think you made like a pretty minor error. We think that this is what's going to happen. And so we're going to go along with what we think is really the truth unless you tell us otherwise. And so a CP 2000 says, hey, you reported $100,000 in income, but really we have records of you having $103,000 in income. That's generally fairly minor, right? So the IRS isn't going to go through a whole audit process for that. They're just going to say, hey, we're going to fix your information for you. If you think we're wrong, let us know before we take care of this. And they'll give you a date. By the time you need to let them know. And so that's the most common way that you're going to get a letter from the IRS, is that it's just a minor change with the CP 2000. If you don't answer any of their mail and you ignore them entirely, you're going to end up with some problems. And so definitely address it as soon as possible, but just know that one, they will never call you first. They'll always send a letter first, and no federal agency will ever ask you to pay for anything with gift cards. That's a really common scam that people will call and say that they represent the IRS or the FBI or some other group, and you need to go buy some Amazon gift card or something and read us the code right now, or else we're going to have you arrested. That's all a scam. None of that is true. You'll never have to pay anything with a gift card. Okay. So that's kind of wrapping up for the tax workshop. I want to make sure everyone is aware that we also will have future workshops about how much do I need to save for retirement, how to talk to my kids about money topics, what do I need to know about health insurance. We have a series of workshops coming up, and they're going to be every Friday. Some will be recorded, some will be live, and we'll keep going with that. So if you need to see about the calendar for the future REACH workshops, you can go to Butte County Library's website, navigate to the REACH program, and see the future workshops. And there's going to be all kinds. Those are the financial literacy related ones, but there's also some for career help and some for using Google for business and many other resources. So thank you all. I appreciate you watching the video, and I will see you in the next one. Have a great day.